Well, hello and welcome to this video where we're going to take a closer look at the market strength indicator for TradingView. And I hope by now you've had a chance to watch the introductory video I recorded, which really explained the primary concepts of the indicator, why and how we developed it, and some of the essential applications of how to use it from a trading or investing perspective. What I'd like to do in this series of videos, where we're going to cover everything from futures to stocks to ETFs, commodity markets, really look at the whole range of opportunities where you can apply the indicator, is, I guess, in essence, to take it to another level. As I say, if you've watched the introductory videos, then you'll be very familiar with the concepts of overbought and oversold. And indeed, if you're equally familiar with the currency strength indicator for the Forex applications, it's a very traditional way of looking at a market opportunity and whether we are going to consider a reversal and get into the start of a trend early when the market reverses off these overextended positions, or alternatively, we are going to jump on an existing trend. That very much comes down to individual attitude to risk and money management. In the first case, where we're looking at potential for reversals, we have to put more risk on the table purely as a result of the fact that the market may stay at that level. It may stay overextended, either overbought or oversold for some time. And therefore, we have to allow for that consolidation, that buffering, the volatility that we often experience at these regions before the market ultimately turns and reverses in the opposite direction, which ultimately, of course, it will do, because no market can stay oversold or overbought forever. It is a constant process of oscillating between those two regions. So in trading the extremes, in terms of reversals, the payoff, if you like, is you pay a higher price for entry, and that higher price for entry is in terms of a wider stop loss, because that is how you have to set it. You have to allow for that buffering, so your stop loss has to be much wider. But the payoff, of course, is that in putting on more risk on the table, you do benefit in terms of greater reward, because you are in at the start of the trend, and therefore you are maximizing whatever that trend is likely to deliver. The trend trader, on the other hand, is going to wait for that reversal to take place and for the trend to develop and get some momentum before jumping in. The difference there is that your stop loss will be much closer, because the risk is of a reversal is less, and you're already jumping on a moving train. So your stop loss is that much closer. The risk is the amount of risk you're putting on the table is much less than a reversal trader. But the payoff is less also, because you've given up the opportunity to take advantage of the full trend. That's already been and gone. The analogy I've used many times is of a train in the station. The reversal trader is prepared to sit on the train and wait for that train to depart, and therefore maximize the journey, whereas you as a trend trader are perhaps jumping on the train lower down once it's underway, and therefore you've given up some of that journey in return. So that's basically what it comes down to, whether you're going to put more risk on the table for higher return, or trade trends for a lower risk but potentially lower return. And that, in essence, is one of the aspects very much of the market strength indicator, which will highlight these regions very graphically for you. As you can see, it's very clear to see where those potential turning points are. When at the lower levels into oversold, we get down into single figures, and at the upper level in overbought, we get up towards 100, well into double figures at the top there. The other aspect to it, which really reinforces that, is when we're looking at this graphically, in terms of trends, we're looking at the steepness of the line. And as you can see here, we've got a very steep line, so clearly a strong trend. Equally to the downside, strong trend, because the lines are very steeply inclined. The angle of inclination is very steep. So again, it's something we look at continuously with the indicator, and all of that is revealed across the time frames. Now, I've got a 1 minute, 3 minute, 5 minute here, and we're starting in the world of currency futures because it is one of the essential building blocks, whether you're a trader, investor, whether you're an index trader indeed, or whether you're simply looking at market sentiment. Then clearly looking at the primary indices is a great starting point. Whether you look at them in the context of futures, as we are here, or whether you look at it in the context of ETFs and look at the SPY, etc., then the principles are exactly the same. We are looking for sentiment. We are looking for, are we in risk on or risk off territory? What is the market doing? Now, in terms of what is the market doing, again, I've started here because it demonstrates a very first of all, a simple relationship, and secondly, the whole idea of using the market strength indicator to give us a clue as to the broad market sentiment. And by that, I mean the river of sentiment. Is it risk on or risk off? I've got 4 futures here. I've got the NQ, the YM, the ES, and the Russell. And that's these 4 here. So you can see them all basically following one another around on these time horizons. And of course, it doesn't matter whether we're looking at this in a very fast time frame context or a slower time frame, the principles will be exactly the same. So immediately we can see from this arrangement that the primary indices, the 4 primary indices for US markets, are essentially moving in the same direction. Now, from time to time, you will see divergence. We see it all the time. We often see it in the daily charts where one might be climbing. For example, the NASDAQ does this quite frequently, particularly given the strength over the last few months of the technology sector and how that is then translated into performance for the NASDAQ. So we can often see the NASDAQ climbing very strongly, and yet maybe the ES, which has a broader basket, and the Dow, which has a very narrow basket, they may be doing something completely different. One could be moving sideways and the other might be moving south. Now, if you're trading or investing in a stock that is in one of those indices, whereas we've got one index moving in one direction and the others moving in opposition, clearly it's something you need to be aware of, and you need to identify why. There's no problem, as provided you know, trading against the flow. And the analogy I use is very much of a river. Generally speaking, we want to be trading with the broad sentiment of the market. We're trading downstream, if you like. The river is flowing down to the sea, and we are basically trading with broad sentiment. On occasion, we're going to paddle our canoe or boat in the opposite direction against the flow, which is absolutely fine, provided we know that that's the case, because the risk on that will be greater simply by virtue of the fact that if we are trading against broad market sentiment, there is always the possibility that the index or stock or ETF, whatever it is we're trading, may reverse quite sharply and join the river. So you've always got to bear that in mind. And really, that's one of the principles that we look at here. So we're looking at broad sentiment in the context of markets that we would expect to move in the same direction, which clearly the indices, being equity related, we would expect them, generally speaking, to move in the same direction, which they are, as you can see. And the other aspect of this is I've also put on the VIX, the VX future, because as I'm sure you're aware, the VIX has an inverse relationship to equity markets, and therefore it gives us a great clue as to which way the market sentiment is traveling. This is all about whenever we're putting together trades, investment opportunities, whatever they may be, we're always looking for the pieces of the jigsaw puzzle. And in that context, we're always looking for opportunities whereby something which moves in opposition gives us an alternative view. It confirms what we're seeing, it confirms what we're doing. And the VIX relationship to equity markets is a very classical one, which is why I've started here, because you want to see this inverse relationship maintained all the time. And that's pretty much what we're seeing. The VIX here is this pink line, which you can see on the 3-minute rising very strongly here. And that's in counter opposition to the indices here, which are falling as a group. And that is the relationship that we expect to see maintained. And it's a great relationship also to see what I've done, which I'll pop over to in a moment, is I've also broken this out into our traditional time-based charts, because it's another way of getting an upside down view, if you will, of what we're doing. And by that I mean you will be looking at an index future on a chart in a traditional way with volume price analysis, which underpins everything. And then counter to that, you've got the VIX, which is working upside down. So you get this inverse view of volume. There is volume with the VIX. It's very similar in the way that we use, for example, in the Forex world, where we use euro dollar and dollar Swiss. Those two generally work in opposition to one another. So you get a great alternative view of volume price analysis in that way. And I can't stress how important it is because, for example, when you see an upthrust on one chart, what you should be seeing on the inverse, if you like, is a hammer. So you just get this lovely mirror-like view, if you will, the inverse view of one over the other. So I think that's really covered the basics that I wanted to get across here to, as I say, to move the conversation on to really within this series of videos to start to plant some ideas in your mind of how you might use this indicator in different ways, not simply looking at it as a market strength indicator for reversal opportunities, which is fantastic, or alternatively strength of trend, again, great. It's really to bring in these ideas of looking at markets, broader markets in terms of the sentiment of that broad market, and then to plant that over a market which we might expect to travel in an opposite direction to give us an alternative view, which is precisely what we're seeing here at the moment. So with that said, let's move over. I've created two workspaces. I've had to break them out on TradingView because it didn't give me precisely what I wanted. But what I've done, as you'll see, is I've got a market strength indicator and I've got three charts for one of the indices, and then I've done the same for the VIX. So you'll see them on the two different workspaces. So let's do that now. Okay, here we are on the first of these, which is for the index itself. And as you can see, on the left-hand side, we've now reduced this to one of the indices, and I've gone for the YM here. So that's on a 5-minute time frame on the left-hand side. So that gives us a very nice view of what the YM is doing itself on that particular time frame. And then over on the right-hand side, we've got three time frames which mirror what we saw on the previous workspace. We've got the 1 minute, the 3 minute, and the 5 minute. And we're using this in a very traditional way. As I say, volume price analysis underpins everything we do. I don't propose to turn this into a VPA lesson, but I can't stress too strongly that volume price analysis is the anchor, it's the cornerstone of everything from which everything else flows. And the indicators that we've developed, and this has always been the case, the indicators we've developed are very much a supportive methodology for our volume price analysis, which underpins everything. So as you can see, we can read the chart in the normal way. We've got volume here. We can see where we've got some buying coming in. And the market's quite quiet at the moment. And just to put this into context, we're actually trading on Globex at the moment. So this is midway through the London session. And of course, the volumes will pick up dramatically as we move into the US session later in the day. But essentially, you can see everything here as we see it. Let's just move that out of the way. Let's just pop this there we go. Just pop that up full size. And let's move that up a little bit. There we are. Again, as I say, very traditional, very typical. We have our VPA. We might have other indicators on here. For example, we might have the accumulation distribution indicator because levels are always important. And typically when we get to regions like this, we have a congestion phase here, very nice congestion phase with a floor of support here and a ceiling of resistance. And then we get the breakaway from that. And breakaway trading is a wonderful way to take advantage, but you have to be patient. And it's very similar in a way to the approach we have to take when we're looking at reversal opportunities. Patience is everything. We have to wait as reversal traders for that trend to take place. It may happen in the next 5 minutes. It may happen in the next hour. We just have to be patient. The same is true of congestion trading. We're waiting for that breakout. We know the market can't congest forever. It will have to move at some point, and it's just a question of not if, but when. And when the when comes, then obviously we're looking down here at our volume price analysis. We're looking at our volume. Is it confirmed? Is it supportive? Do we take this opportunity? And the beauty of congestion trading is very much that it really defines these levels very clearly for you and also gives you a very, very clear view on where to put any stop loss, provided it fits your money management rule. Clearly below this level is going to be a very strong area in terms of any minor reversal or retest of that region. So congestion trading is wonderful, but like reversal trading, you do have to have patience for to succeed, and just be patient and wait for the trades to come to you. So it's relatively quiet at the moment, but again, it's all defined over here on the market strength indicator on the left-hand side, and that gives you this wonderful heads up. And the other beauty of the workspace that we looked at earlier on with all three of them is you really don't need multiple charts. It tells you instantly and graphically what is going on, and of course you can have that set up in many different time frames. It really does give you an instant view of what is going on in terms of sentiment across the market. So that's on the YM itself on the 3 time frames. And finally, just to wrap up, let's go and have a look at the VIX 2 in the same setup. And there we are, precisely the same setup as I explained. On the left-hand side here, we are on the VX, the VIX future, and it's climbing, not climbing rapidly, it's just climbing very steadily. And that's in opposition, in contrast to the YM, which we looked at on the previous setup. As you can see, not particularly fluid price action here. The VIX is in congestion, really not going anywhere terribly fast at the moment. But also, as you can see over here, this is during the US session. You will see much more fluid price action because the volume traded through that session, where you've got both the cash markets and also the Globex running in parallel, the electronic markets running together. Then that is where you see the largest volume, of course, and a lot more fluidity, particularly in terms of the VIX itself. That said, and I've said this many, many times on many webinars I've done with Anna and on videos I've recorded, trading on Globex is in electronic markets is absolutely fine. And indeed, I endorse it and I encourage people to do it, because what you will see is much more straightforward price action. There is far less volatility. The trends are more straightforward. You do not see very sharp reversals. It tends to be more measured, more even paced. So if you're new to index trading, or indeed if you're in a part of the world, the Southern Hemisphere, for example, where perhaps these markets are less accessible, or certainly the US market time frame does not work for you well, do not be afraid of trading indices outside of those timeframes. In other words, purely on the electronic market. It works in exactly the same way. Volume can be applied in exactly the same way. The market strength indicator, as you've seen, works in exactly the same way. Everything works the same. All that's missing are those extreme volatile price reactions that we always see at the start of the session, which generally lasts for 15, 20, 30 minutes or so. Then the market calms down, and then we get into the main guts of the session, and volume settles accordingly. But reading volume price analysis on an electronic contract trading Globex purely is absolutely fine, I can assure you. And I trade it more myself than I would do when the US markets are running, to be perfectly honest, certainly in terms of index futures at any rate. So there we are. I hope this video has given you some food for thought, some ideas. It's the first of several that I'm going to record, and very much around this idea of using the indicator in different ways, to really look at it from the concepts of sentiment, broad sentiment for a group of products, instruments that we expect to be moving in the same direction, or alternatively looking at it from divergence perspective, where we expect to see, or maybe we're surprised to see, a market that's moving in opposition to another. So it can be used in many, many different ways, and not simply in terms of just the trends that we're looking at. Obviously, the steepness of the gradient of the lines, we're looking at strong trends, and also those great reversal opportunities, which, if you have the patience and you're prepared to put more risk on the table, are super opportunities for getting into trends very early and maximizing your profitability from whatever that trend can deliver. So I hope you've enjoyed this video. Lots more to come in this series to give you more seeds and ideas to consider. And I'm sure you'll think of many of your own as well. These are just introductory ones to get the grey matter working. So see you soon in the next series. Thanks for watching, and bye for now.